Hi, this is Randy Finney with Right Side of the Chart. This is an early session update for Tuesday, October 29th, 2019. It is 10:13 a.m. Eastern Time as I'm starting the video. We'll just kind of do a shotgun coverage to some of the things I'm watching right now, different sort of a potpourri mix, different asset classes, different securities. We'll start out here with the economic calendar. I meant to cover this in yesterday's video. I had made mention of it, but wanted to cover it in there. So what we're looking at today, we have, of course, the FOMC meeting begins today, but the announcement comes Wednesday at 2 p.m. Also on Wednesday, you have the big GDP report. That's quarterly numbers, so that's always big. GDP, for those who are not familiar, that's the single metric used to define economic expansions and contractions, or i.e. recessions. 2 consecutive quarters of contraction is considered a recession. So again, we're not in recession territory now, but that is, keep in mind, GDP is, to me, it's a pretty lagging indicator. Number one, it's very subject to after-the-fact revisions. It only comes out quarterly, so by the time you're getting, the quarterly information, it's already a month past the quarter. The quarter's already over, and you have information there, data going back, 3 months from when the quarter ended. So just anyway, something to watch. And again, Fed's probably privy to those numbers ahead of time, and of course they don't make their decision till after. But so these are just things to watch. Jobless claims. A couple other things on the calendar: employment situation, ISM manufacturing index on Friday. And remember, that is all. This calendar is available under, click on the resources link at the top menu of the site, and it's down there under tools of the trade, along with the earnings calendar. Now today, one of the big ones reporting is AMD after the bell, big semiconductor maker, and then tomorrow we have the last of the FANGs reporting. Both Apple and Facebook report tomorrow after the bell. So lot to potentially move the markets this week. So kind of a heads up if you're trading the indexes. Right now I've been focused on other things. We're going to get to the indexes quickly. I'll do a brief update. But speaking of earnings, I wanted to show you guys some charts. I'm going to post these on the front page, but I wanted to share a couple charts that I've marked up this morning. All right, this is FedEx versus the overlaid with the S&P 500. And this is a multi-decade chart. So what you're looking at here is this chart spans the previous bull and bear markets. You have a bull market leading up to the this is the dot-com bubble back here, the peak in March of 2000, followed by a vicious bear market. Both of these bear markets were 50% or more. I think the Nasdaq was down 70. I forget how much the S&P was offhand there, but I know this one was about 55%. And so you're looking at really over the last few decades here, all the bull and bear markets. And here's, of course, this is the longest bull market in history we're still at. So many of you probably heard of this one before. FedEx Corp has been long used as a bellwether and also canary in the coal mine for the U.S. economy. And if you think about it, it makes sense that when business is booming and the economy is doing well, there's a lot of packages being shipped. Now, and so basically the theory goes here, and history has showed us that FedEx has peaked. Again, it's been a good leading indicator of the stock market, because in each of the at least the previous 2 bear markets, again, we have a couple decades to go back here. A lot of FedEx was only in its infancy back in the 90s, so you really want to look at modern day. You want to go back just a couple decades here. And anyways, you can see there, I marked it here. S&P 500 peaked 11 months after FedEx back in the market. FedEx peaked in May of 99. Market peaked in March of 2000. And here you had really a series of about triple tops. You can see several almost equal highs in FedEx. So it was really more of a range. FedEx peaked right here. Flattened out from April 6th to March 07, which was better than half a year, up to about 1.5 years before the market peak. So we'll call it 1.5 years before the market peak there. And so far, now we can't say the market's peaked yet. All we can say is it just made a new all-time high. But FedEx clearly, I mean, make no mistake about it, it's not just a correction. FedEx peaked a year and a half, 1.8 years ago. back in January of 18. And you can see this appears more than just a correction. This appears a lot like what it was back then, those bigger drops. So that's one of them. And again, you've probably heard people talk about this. Now, what prompted me to do this other chart here is I was reviewing the companies that reported today, and one of those companies, I'm pretty familiar with this company, A.O. Smith Corporation. If you are in the construction industry at all, or you're kind of a do-it-yourself homeowner like myself, you've probably heard of this company. I replaced my own pool pump. Did that 6 months ago. It's an AOS motor. My boat lifts AOS motors. They make electric motors. Here's a description here. They manufacture and make a lot of both residential and commercial equipment, gas, electric water heaters, boilers, tanks, treatment products, blah, blah, blah. You can read all about it. Yahoo.com Finance, or Yahoo Finance, is a great source. That's where I clipped this description here. But here's the thing. Now, so when I saw that company, I'm familiar with it, and I know that they happen to be, which is rare, a domestic-based company, a U.S.-based company. That's not a lot of manufacturing going on in the United States anymore. We build cars here only because we have to. The Japanese makers had to come in, and they couldn't import cars anymore back from tariffs back in the 80s. That's why your Toyota or your Honda you're driving is built in the U.S. And again, that's if it weren't for tariffs and things like that, the long-standing tariffs, we probably wouldn't have any cars built here anymore. So my point is, last TV, the Zenith, was made in back in the 70s, 80s. There's not a whole lot, but this company, I like it because it's domestic-based, and it's a very good tell to the strength of the economy. I mean, if these are, things going in homes, commercial buildings and businesses, and it's going to reflect the economy. And as you can see, just eyeball the chart. In green you have AOS right here, the stock, and in white you have the S&P 500. And you can see how they nearly perfectly mirror each other. However, you get a lag time here. So AOS peaked back in July of 98, whereas the S&P 500 peaked 1.7 years later in March of 2000. And so you could see it was certainly a tell back then. And before that, my point is it tracks very well with the economy or the S&P 500, because it's going to again mirror economic conditions. And so there was your 2000 to 2002 bear market. Okay, we enter bull market. They both start rising again. AOS peaks right here in April 2006. Right there, again the green and red, that's AOS. S&P peaked 1.5 years later. And most recently, again, you can see how, look at this bull market, just look how perfectly they marry each other. This is the economy's growing, it's correcting with the market. However, AOS stock peaked back in February of 2018, and that was 1.7 years ago. Exactly how long it peaked before the 2000 top, and nearly as long as it peaked. That's a little longer than the peak before the market top in 07. So take it for what it's worth. But these are the things that tell me there's two markets going on here. I mean, there's the and this is what I'm seeing. And everyone sees what they want to see: glass half full, glass half empty. I'm seeing industrials, good things, fundamental economic indicators rolling over, yet the market goes to new highs, and that is, as I said, that is, I can't say exclusively due to technology, but largely, and I can tell you without a doubt, if technology was lagging like the industrials and other things, this market would be well into bear market territory by now. So again, it's just due to the nature, there's been a big shift in the last 50 years in the U.S. economy from, industrials, which used to lead, and that was the biggest part of our economy, to now, it's been overtaken by technology and even to a large extent financial companies. But again, so this is just a tell. Now, you guys are probably tired of hearing this bear speak. Take it for what it's worth. Now, here's the thing. We don't have any sell signals on the stock market now. So you shouldn't be fighting the stock market on the short side. It's just telling me that chances are the writing is on the wall that this run will soon be over. Yes, I've been saying it for a while, but yes, the charts have been reflecting that for a while. So we'll wait. And the takeaway from this is, when we start to get sell signals, it tells me the next time we have some solid sell signals and we break the weekly trend lines and those longer term trend indicators that I'm looking for, it tells me to that I might want to put away a short position as a trend trade and go for that 20, 30+% downside that the charts are telling me is coming, versus just trying to game a 8, 10% correction in the stock market. So that's where all this comes in. And the thing about investing and trading, patience pays. Patience is a must. In fact, I have a saying, if patience is a virtue in life, it is an absolute necessity in trading and investing. So we'll wait for that. And again, I think this chart's interesting, but I'll go ahead and post it on the homepage later today. All right, so let's dive into the charts now. Again, that's all longer term stuff that may or may not play out later. But as far as the indexes go right now, we're looking at NQ. We have a little minor trend line. I don't have a high weighting on this trend line because there's only a few reactions. We broke that. We still have negative divergence that's been building here on the 60-minute charts. We have it out on the daily and the weekly and even the monthly charts. So right now, on all my time frames, we have divergence, and we have a lot on the economic calendar that could trigger the spark that sets next correction in motion. And as I've said and highlighted repeatedly, there's one consistent pattern over the last couple of years of this market making marginal new highs and then correcting, substantial 5% plus 5-8%, even 20 something plus corrections coming after those marginal new highs. So we'll see if that pattern continues. So right now, maybe watch this trend line. Well, I can say watch this one. Here's a trend line. You can see it on the NQ 60-minute charts. The divergence got taken out here, but we also have an extreme overbought reading. And as I've covered in the past, when you hit this extreme overbought line, about 85 on NQ, the NASDAQ 100 futures, the upside from that point is usually limited before a correction. That's been the case. In fact, that correction from this overbought reading didn't stop until we came all the way down here. So we had one there, and again, that set up that head and shoulders, and and we had one right here. That led to that drop, and there we are again. So it's about risk reward. You have cross currents. We don't have any strong sell signals. There's a minor sell signal on that break there, but again, a lot going on the economic calendar, so you guys can expect some volatility. And if you're not comfortable with that, just stay away. Wait for the next best or next better looking setup, I should say. Yes, S&P 500. Nice little wedge forming. So we have a comparable trend line to that I just showed you on NQ. There it is, your uptrend line. There's your divergence. Nice, clean, bearish rising wedge. There's your negative divergences still intact. So I'll tell you, as I do the video, it's looking a little bit better. We don't have the sell signal yet, but watch for a break of this trend line. And we have enough earnings on deck this week that could be the catalyst. We have the Fed that could be the catalyst, or sometimes and quite often it's the technical breakdowns the catalyst, and then the news will follow. The news will be the Fed not being as dovish as people expected when they make their decision and then give their press statement on Wednesday at 2 p.m. We'll see how Apple goes, all that good stuff. But right now, the charts to me look like they're pricing in a correction. We just need that sell trigger there. And then IWM or RTY I'll cover. RTY, this wedge broke down. It's been back testing the lowermost trend line right here. This the one that's highlighted in purple right now. Breakdown, back test, negative divergence still intact. We're stretching. We had the divergence at this recent high, and we continued to diverge, and that's what small caps look like. I should probably give it to you guys on IWM 60-minute chart. There it is. You have similar wedge type pattern. Really, this was a trend line that was broken and being back tested. That's the wedge line right there, and here's our alternative secondary trend line right there. So break of that one should bring us back on IWM, SPY. I really haven't had time to mark these charts up yet. There's so much I want to get out to you guys, but there's a trend line on SPY to watch. There's the new high. So far, not very impulsive. That's the other thing. SPY broke out to new all-time high yesterday. We got close enough. It was pretty much baked in the cake. The odds were for a breakout to the new highs, but very lackluster. I've talked about this lately, the low volume, extreme low volume in the market, which is indicative of non-confirmations. The institutions aren't buying aggressively here. Overall, people in the market aren't buying aggressively, I should say. That's what the low volume tells us, and so let's see what happens there. There's a potential on the 60-minute chart for an island cluster top, which means you have a gap up, creates an island. And again, just potential. I just point out these potential scenarios, whether they pan out or not. But so an island cluster is when you have a gap up, leaves a cluster of candlesticks that form an island, and then you gap down below that island. And if so, I can tell you the trading strategy, my preferred strategy, you go ahead. Once you get that gap down, you have an island, short it. They're high probability, especially when you have things like divergences, everything else that confirms that a pattern of the market breaking to new highs. So you would short it there with a stop. Now, you can have a very tight stop just above the bottom of the island, but from my experience, the market makers, the powers that be, will try to run those stops. So best to put it up about 2/3 of the way up into the island. I mean, you're talking a minimal amount if you gap down, very, very small loss. And what I really like about island cluster tops or island tops when you have a single candle, or in this case, here's a SPY, you have two candles, so you'd have a potential island cluster here. And that what's nice about it is they come after an extended uptrend, and they're used as the name implies, an island cluster reversal top, a topping pattern, not just a corrective. So what happens is you usually get a significant trend change afterwards. So what I'm getting at is the risk. It's all about risk reward. So let's say you gap down tomorrow or Wednesday or Thursday. I don't think the market's going too far until Apple reports. I can tell you that now. We have the Fed on Wednesday, followed by the post-FOMC noise, and then Apple on Wednesday. Why position too heavy, or I should say don't expect much until Thursday? So let's just say then, okay, we trade again sideways today and tomorrow, and then Thursday we gap down. So again, you're looking at maybe if you gap down to this point, you put a stop up here. So you're talking less than 1% risk. Assuming a gap down to this area right where my crosshairs are. 1% downside risk to what could potentially amount to 30% or more downside if my longer term target's hit, if this happened to prove to be the final marginal new high and top. And at the very least, if we have this pattern of 6, 7, 8, 10% plus corrections that we've had each time the market's made a new marginal new high, well, that's still a phenomenal risk reward. A risk reward ratio of 6, 7 to 1, maybe 8 to 1 or better. Typically I like anything 3 to 1 or better on a risk reward profile. So food for thought there. And again, potential pattern, we'd start moving up here and maybe we don't even get that island cluster top. So I'm just throwing all this stuff out there because you have to be reactive in the markets. You have to look at scenarios, anticipate, and then react if that scenario develops. And if something else develops, and that's what we'll be looking at maybe a week, 2, 3 weeks from now, 3 months from now. We'll see. And here's QQQ on the daily chart. Another new divergent high. Like I said, just simple an extension of the previous divergences. And then if you take away all the trend lines, you can see you have right now an island right there, 2 candles. It's not separate. It's not officially an island. Well, it is an island, but it's not an island top. You need that gap down to confirm it. So again, that's one of many potential scenarios we'll be on watch for. And if I see it, maybe I'll throw out an official trade idea. And if I don't, I've already outlined it. What I'll be doing, what I think is an objective trade. And again, trade, nobody bats 1,000, not even close in trading. And you don't even have to bat 500 to be successful. You just have to use a favorable risk reward. The lower your risk reward, if you're trading 1-to-1, meaning you're risking $1 of loss on every trade you make to make $1 in profit, that's a 1-to-1 risk reward ratio. Well, yes, guess what? Then you have to bat well over 500, or you might as well not be playing the game, meaning you have batting over 500 means more than half your trades are successful. So again, it's all about risk reward. So if you keep the losses small, but your winners ride or have larger profit potential, like our Bitcoin trade the other day, what was our downside risk on that had we been stopped out? Where did I put it? It was on the 60-minute chart. I forget where the stop was. It was somewhere down here, but that was a very good risk reward. You know, that trade went up, whatever it was, 20, not 30% or so, and you know, worked out for us. But had it not, no big deal. Would have just done this again and again, and we would eventually get one right. And let's move on to other trade ideas. So here's UGAS. Getting a little stretched, but I'm gonna, if you're new to the site, or if you're new to trading, let me tell you something. Fewer securities can run when they want to run, like natural gas. I'll put them right up there with the shipping stocks, with the cannabis stocks at times, where Bitcoin even, when they want to run, they will redefine overbought. So if you're selling because you're up 10, 15%, these things can keep going. Now, with that being said, I'm going to give you some levels, but I've highlighted UGAS and NG, natural gas futures, since back here in this little, with this divergent low and the bullish falling wedge. We had a breakout right there, and I know quite a few of you took it. Some might have been shaken out or stopped out, rightfully so, on that drop down we had recently with the NOAA forecast. But as I've covered recently, the trend's still intact, and very bullish, the fact that we recouped all that and then some. So I'm still intermediate to longer term bullish on that gas. We have seasonality in play here. Even NOAA said they expect a warmer than normal winter. I think that a lot of that was priced in. I think there was too much pessimism, and again, the charts were constructive. At the end of the day, I can sit here, ramble all day long on my thoughts on how warm or cold the winter might be, what supply disruptions might be in the works with natural gas, blah blah blah. But the charts are going to be the guide ultimately, and from here we had a breakout, and so there's another security up about 30% since it was highlighted back here, and it's still running, this one. Bitcoin, like I said, I'm out. You guys can trail up. I just wanted to trade what I thought was a bear market rally, counter trend bounce, to where the RR profile is no longer attractive. Just going back to that GBTC, we hit that trend line, and again, that's all I wanted out of it. Natural gas, I have set a stop in place. I think there's potentially more upside here, but it is getting stretched. Like I said, it can get quite overbought. Overbought can become more overbought, but here's what we're looking at. This is a 6-month chart using 2-hour candles. Lately, I've been showing you an hourly candlesticks, 60-minute chart. And there is some resistance right around this level here. It's not a hard line. I can lift that line up a little, come in here, and what I'm showing you is I'm catching these previous reaction highs here back in July, another one here early September, reaction low there, and we're above it by a little bit now, and as you can see, getting pretty stretched. But again, you can become overbought here. You're overbought, you had a little blip, and you just kept going up. So that's the nature of natural gas. Overbought can stay overbought or become more overbought. And like I said, it's so far so good above this level. But if I add a second line here, we are coming up on pretty much a resistance zone, if you will. And so we're going back here. We have some reactions there, a couple reactions there. Maybe put that line about right here. So we'll call this a resistance zone. So what I did on my trade, I'm still in it, letting it run, and I've raised stops are pretty tight. I can tell you where it is now. And NG, where's my? If it hasn't been hit yet, let me look at another monitor here. Good to cancel stop at 2.634, and I may ratchet that up too. If you know, if NG continues to ride, I'll probably just trail it up right now. It may jump back in there. So anyways, that's how it looks. And let's go back to that 60-minute chart I've been covering lately. And we'll go to this 3-month view. And that's it. So we took out that 2.6 or so target you can see on this 60-minute chart, and that's the next stop I have here on this 60-minute chart. Again, we were just looking at a 2-hour chart a minute ago. So coming up, and that's probably around the top of that resistance zone I just showed you on the using the 2-hour candlestick. So at that point, you know, I'm going to keep trailing up, and if we get close to that 2.7, I'll be taking profits and looking to enter maybe enter in a pullback. We'll see how things go. And a lot like crude, which I'm about to get to next, there's an uptrend line here so far in play, and that's something, again, it's a lot that can happen going forward, but should we pull back more than that, beyond that 2.6 or so level, maybe a pullback to this trend line, and or I think at worst case scenario 250 should hold right now. 250 is a pretty big level on, you can see right here, starting with this reaction high, some reactions here, and all this stuff. So this was sort of a basing pattern which natural gas just broke out of. So that would be worst case scenario pullback. Anything much more than that would really start to chip away at the bullish case. And next up, crude oil. I did cover that, put up a couple charts this morning, and on Friday I had an update that I made on crude. We were right about here, so I said, we had divergence, but I could see that divergence continue to expand. Usually you're going to reverse, not at a random point, but at a resistance level. So that next level I had overhead at the time was 56.88. We went up. That gave you not one but two almost perfect shorting ops at that level. You had extended the divergence, and then I said if reverse from there, and if it breaks 55, 54, that should take us down here to at least the 54.75, which is what was and still is my minimum target. That's where I covered in reverse today from short to long. And possibly if it goes on down through that level, a little more downside here, there's a pretty nice uptrend line similar to that one I showed you on NG, natural gas, but we're a lot closer here on crude. So there's your what you call it, scale-in zone if you plan to go long crude with a stop somewhat below. And you can see there's still support down below that, but that's where I'm, give it a little bit through there, not much. And now, as far as where we might go, at minimum is a bounce up here to the 55, 54 level. So at which point I'll put a pretty tight stop in case that we do bounce. First of all, we haven't reversed yet. We're right on that level, a little bit above it now, 54.85. So should we go up there, and then I'd put a tight stop, relatively tight stop, because that could be it, and then we could come on down here, but we may go on up. That may be it. And if we go up, you want to look for a break above that 56.88. We already were checked there twice in reverse, and so now if we've had a correction, may come back down here to the trend line. We haven't visited that trend line in a while, and that's why I'm leaving some room to add if we do get there. It'd be nice to get that reaction off there, and if so, then you want to look for, ride it up here. And my expectation is that the odds are pretty good for a breakout, even if we get another reaction there. This is how I think things would happen. So we reverse, probably get a reaction because it's resistance, but not much of one, and then break out, and that might take us up here to this 58.70 target, at which point that's where, if and when we get close to that level, I'll be booking profits if I haven't already been stopped out or taken profits for whatever reason. And one of those reasons might be the stock market again. If that reverses, because crude and the market tend to have a pretty high correlation, they tend to rally and fall together. Not always, there's sometimes temporary disconnects, but again, overall that's usually what you're going to see here. And gold took out the trend line and the 1492 level. It may prove to be a fake out, and I suspect it will if the upside in the stock market's limited. But again, the market's just broke to new highs yesterday, the S&P, and may have more upside either in both time and or price. What does that mean? Maybe 2-3% to the upside. Probably that's been the MO lately. Much more than 3% after it broke out to new highs. But it also can take. Sometimes you just kind of trade around in a range. We've reversed anywhere from the next day to several weeks later. And so again, gold will probably cue off the stock market, but it's below that level today. I had taken some yesterday, and I threw it away this morning since we're down below that level. If it look, I suspect it will probably recover that level, but from a pure technical perspective, it's not in a good place. So I can always buy back if it does, but I just want to point that out, that it is below that, not by much. It's at 1488.90. That's 1489, and 1492 is the level. Trend line's just above it, but again, I'll kind of let the market run its course. And just as I don't expect any big fireworks until at least Thursday on the market, same thing's probably not going to happen in gold if that's the case. We'll see. Now, I did yesterday, kind of to hedge up, even though they don't have a one-to-one correlation. Platinum's been acting, or not platinum, palladium has been acting funky lately. But based on the charts, I shorted palladium, went long gold. Again, I covered the gold. Sold the gold long today for a loss, but platinum actually more than offset that. And what I'm looking at here, again, this one, I keep calling it platinum, palladium, palladium, guys. They tend to move together. It's closely related to platinum, but there's been, as I pointed out, a huge disconnect between the two. Tremendous outperformance to the upside by palladium compared to their usual relationship. So what I'm looking at here is a big divergent high on the 60-minute chart. Now this swing, it continues to shrug off divergences. It puts in these little divergent highs and usually get little corrections, and it just keeps grinding up. But I'm waiting for, well, I'm going to hold out for now. I'll lower stops at least to break even at this point. But if we can break this trend line, I want to show you too on palladium, the ETF, PALL. I've highlighted before. We have a 60-minute uptrend line as well as this uptrend line on the daily chart. So this is what it looks like on the 60-minute chart here. Nice, clean negative divergence. So watch this trend line for a break and a potential sell signal. It's not perfect. You have to exclude a few candles here, but it comes in pretty good. You can see a pretty clear uptrend there, and you can see 2 near-term targets, and I'll probably add a third there. I mean, once this thing breaks, it's got a lot of catching up to do to the downside, I think. And there's what it looks like on a daily chart. Again, I've shared this chart recently. There's your negative divergence, continues to diverge here on the daily chart. And so it's a nice clean price channel. It shows pretty well on this daily chart here. And a break of that price channel. I just gave you some near-term support levels on that 60-minute chart. You can pick them up here as well. One there, one there. But there's a possibility, I believe, to come all the way back and back test this downtrend line here and intersecting uptrend line. So it would look something like this. You know, maybe a couple hiccups along the way, but come on in here, somewhere around there. And what would that mean to you if it does play out like that? Well, let's just wait. Let's measure from the breakdown there. If it were to break down soon and come on all the way down here, you're talking about 12, 13% downside in palladium or PALL. And coffee continues to stair step higher. There's a 60-minute chart I've been showing you. Reverse a little shy of that 10230 level today. Here's what it looks like on a, yeah, that's a 6-month chart right there. Actually, this is the one I've been showing you here, was this hourly chart. Well, the 10124 level, that's where we reversed, and there's a little uptrend line that was taken out today. That uptrend line should be like this. So, you know, maybe, you know, coffee's, you know, getting ahead of itself, but it's volatile. It's been stair stepping up. You just have to give it room, especially if you're trading the futures. And remember that they, you know, the trading hours are quirky on this one. But there's some potential divergence, so it could be a little bit more there on coffee. Ideally, it should hold up around this 98 support level or so on a pullback. And worst case would be all the way back here at about 95.60. For you ETF or ETN traders, you have the Joe unofficial trade. We broke out of the trend line, hit this 33.82 as resistance right there. We've added that line to the chart. Next one's about 34.70. And then some additional targets up there. But again, we're coming off this divergent low, which is bullish, so there's potential for more upside in coffee. All right, this video is getting long. There's a lot of ideas I want to cover, but let me just stop here with wheat and corn. They're related. ZW or wheat futures, a little bullish falling wedge right there with positive divergence. It's in an uptrend. Wheat has been clearly stair-stepping higher. Just haven't updated in a while. And then what's the other one? ZC corn. Same thing. You can see your downtrend line. These are 60-minute charts, by the way, guys. And you can, the ETFs for this are CORN, very easy for corn, and then WEAT, so wheat without the H on wheat. So these are corn futures, so you look for a breakout here. That could be catalyst for a new move back up to this 400-ish level soon. And again, just like corn, you have positive divergence. And again, wheat and corn move very closely together. I guess I'm assuming, I'm not a farmer or anything, but I think they're interchangeable crops. You know, they're growing in the same climates. And they're both being used as, you know, feed for cattle and other things like that, and livestock. So, you know, the prices tend to rally and fall together. So keep that in mind. If you're trading one, you're pretty much trading the other, or you can just here it is. And so back here, I showed you this bullish falling wedge. It broke out. I highlighted that in advance, ran up here, and I think more recently I would have highlighted this one as well, the second bullish falling wedge, ran up to that 46-ish target. That's a big level. So if we can pop above there, this one could run. So there's a potential bottom being pounded out. Commodities have been in a bear market for years now, but they're starting to really firm up the longer term charts. And so I think, if nothing else, I'm a big proponent of asset allocation. That means, to have your money a little bit in the stock market and equities, certain equity classes, certain sectors, I should say, bonds, fixed income, gold, precious metals, crude oil, natural gas, at different times, not all at once, whatever looks most attractive. Like lately, natural gas. As of, this morning, I'm long crude. Yesterday I was short crude. So, long, short on those things. But what it does, it helps give you a portfolio that fires on all cylinders, or at least most cylinders. I use the analogy like, for those gearheads out there, for the old 8-cylinder cars, now everything's electronic. But back in the day, if you had a 8-cylinder V8, you could lose a cylinder, even 2 cylinders. Your car is going to sputter and backfire, but it's still going to run. And that's the way I look at trading. Is you have 1-cylinder portfolios, everything in the stock market or everything in gold stocks. And 1 cylinder stops working, your car doesn't move. You're going nowhere. So that's my kind of in a nutshell, my thought on trading, whether you're active trading or investing. Same premise. Asset allocation is key to smoothing out the bumps and actually enhancing returns over time. All right, we will wrap it up here. This has been Randy Finney with the Right Side of the Chart, and I'll follow up with any additional trade ideas on the site with some static charts. Have a great day.